All right. Welcome, everybody. I am Tarl Yarber with Fixated on Real Estate. Welcome to another episode of Experts Live. I am here with some amazing panelists once again, and my good friend, Mr. Jay Scott, who's with us every single week as the perpetual guest, who cannot be the co-host due to contractual obligations with Bigger Pockets Business Podcast, which check out the Bigger Pockets Business Podcast when you get a chance. So this week, we are going to be discussing the 2021 real estate market crash or opportunity, which we will dig into more. So, quick thing. This isn't virtual.
Oh, I hate this guy.
Oh, yeah. I'm right. I know you can't see it, but Brandon's Turner's house is like right below me because he is beneath me. That's right, Brandon, if you're watching this right now. We have a house directly behind him. Sucker. We stalked him. We found him. He doesn't even know we're here. Anyway. So let's get on to the panel. So I am excited to introduce my guests today. We've had these guys on before, back during the lockdown in April and May of 2020. We had the lockdown and we didn't know what was going on in the market. So we brought on all our super cool friends every other week. And one of our webinars we had was with Dave Van Horn and Brian Burke. Welcome back, guys. And let's talk about these dudes. So Dave Van Horn is the CEO and president of PPR Note Company. Dave Van Horn is the president of a holding company that manages several funds that buy, sell, and hold residential mortgages nationwide. Dave's expertise is derived from over 30 years of residential commercial real estate experience as a licensed realtor, real estate investor, and fundraiser. As the latter, Dave has raised over $100 million for both notes and commercial real estate. I think you've raised a lot more than that now. Yeah. Dave is also a national speaker and weekly investment blogger on biggerpockets.com. Welcome back, Mr. Dave. You're in Pittsburgh?
Philadelphia. Don't insult me.
Oh, sorry.
Nah, Pittsburgh's a cool town.
Yeah, it's all a P word and it's in Pennsylvania. Brian Burke is CEO of Praxis Capital. Brian Burke has purchased over 3,000 apartment units and more, over 500 single-family homes, and raised over $100 million as well from investors throughout his investment career. Brian is the owner of Praxis Capital and is a very active contributor at biggerpockets.com. You can learn more about Brian on Bigger Pockets podcast via episode 376, 152, and he also wrote a Bigger Pockets book, which is called The Hands-Off Investor. Right?
Yes, sir.
Just double checking. I just bought that book, actually. And no joke, out of all the Bigger Pockets books that I haven't bought yet, I was looking at him and I'm like, I should probably buy Brian's because I haven't bought his yet. And I will actually read that one. So, like, Jay Scott, I read
has a copy.
Oh, Dave, do you have a book too, right?
Yes. Somewhere around here. I can't find it right now. Real estate note investing that I wrote with Bigger Pockets as well. Oh, there you go. Yeah.
Oh, look at that. Buy them at your local Barnes & Nobles, right?
There you go.
Do those exist still? Actually, here in Maui, I saw a Barnes & Nobles, if you can believe that. I was like, oh my God, there's a Barnes & Nobles here. That's crazy. And last but not least, we have Jay Scott. Jay Scott is CEO and author of 123 Flip. And also he's an author at biggerpockets.com. Entrepreneur, technologist, investor, advisor, host of the Bigger Pockets Business Podcast, author of 4 Bigger Pockets books, including the book on flipping houses, the book on estimating rehab costs, the book on negotiated real estate, a real estate investor that has completed over 400
and deals. Not as good as these books right here.
But they're better. So
no, they are not.
You must have a lot of free time, Brian.
So he's also done a bunch of stuff, blah, blah, blah. Jay's awesome. Wow. Love him to death. Yada, yada, yada. Welcome, guys. Happy once again to have you all. 2021. Let's first talk about 2020. And let's, more importantly, wish everybody a happy Veterans Day.
Thank you for everybody who served.
Thank you, everybody that has served. We appreciate you all, especially those that you are still deployed out there and those of you guys that are serving in the military ever so graciously, as well as those that have served veterans alike. So my father was a veteran, and we have a lot of friends that are veterans and still active duty currently right now. So thank you all. That said, get to real estate investing too, with all that extra income that you might be making as a military personnel. There's a gentleman actually, I can't remember where he's out of. He hit me up the other day. He's a real estate, he's actually currently active duty real estate, Special Forces, Green Beret. Great dude. We talked for like an hour and a half the other day. The guy's got 72 units already.
Oh, wow.
And he's only 28, if I remember correctly as well. And so he's actually getting deployed here again soon. And he just tied up a 40-unit apartment complex as well. And he's active duty military. So if he can do it, you can do it too. All right, 2021. Let's talk about this. But first, let's talk about Brian. Brian, earlier this year, when we were talking about 2020 and what was going on, we had a major crisis going on, lockdown, everything. There's still a crisis currently. And we were all worried about what was going to be happening with landlords. You own a lot of apartment units. You also have a lot of single family rentals. And we didn't know if people were going to be paying their rents. We found out people did pay their rents. Most of them did, but there's still an eviction moratorium throughout there. Did you just stop? I know it's been about, almost 6 months, 5 months since we talked last on a webinar. Did you just stop buying? Or what have you done this year so far in 2020? What have you changed in your investment strategy, if anything at all? And what have you done so far now as of 2020?
Well, our plan started out one way and went another way. So the goal for 2020 was to sell 1,000 units and buy 2,000 units, because last year we bought 1,000 units and I wanted to add another 1,000 this year. But that plan got derailed by COVID, obviously. And when the pandemic hit, we literally had closed escrow on our last Houston property sale on March 20th. And then the world got locked down like about, 5 or 10 days later. And and then I thought that was going to be the end of anything for a while. I figured we wouldn't be selling anything. We wouldn't be buying anything for probably a year or more. But it didn't work out that way. We also thought that we'd have a lot of problems with people paying. We thought we wouldn't be able to make any distributions. And it didn't work out that way either. So instead, what we saw was we had some properties. We were actually getting month over month collection record highs. We had a little bit of eviction that were hanging out, but not a lot. It really wasn't quite so bad. The older properties didn't do as well as the newer ones, but overall we fared pretty well. So we then figured out, come about, I guess around May or June, we figured out the market wasn't in total shambles. So we had one property we had started marketing pre-pandemic and had a few offers. We went back to the buyers and see if anybody was still interested, and they were. And we sold that property. I think we haircutted the price like $100,000, and it was a $30 million deal. So that was like almost nothing, really. And we got that closed. That closed in the middle of August. We generated a 25 or 26% IRR for our investors over a 3-year hold. So it was an incredible outcome to sell that during a pandemic and produce that kind of a result. Realizing then that the market really was still alive and well, we started looking for more assets to acquire. It's now November as we're recording this, and we started really looking again in about June or July, and we found something right away. We had a property in contract in September. We closed it in October, and that was 264 units in Tampa, Florida. We just acquired, and we got a second property in contract. In fact, I signed the purchase agreement this morning on another 200 units in Tucson, Arizona. So, what we thought started out, thought the year was going to be a dud. It's actually turned out to do quite well. We'll have sold 2, if not 3 properties this year, which will be about 700 units, I think. And we'll have bought 450, not quite the 1,000 to sell and 2,000 to buy that we'd hoped for. But given the circumstances, I think we did pretty darn good.
But why do you think that, you were able to sell for so high and that you've been able to do what you've done so far in 2020?
A couple of reasons. Number one is we buy in really strong markets. So, the markets that we're buying in, people are moving to these markets, and that population growth is fueling multifamily demand. So that's part of it. If we were in a really sleepy market, maybe we wouldn't have done so well. If we were in a really high-priced metro market like New York City or San Francisco, we'd be telling a completely different story right now. But with the markets that we're in, they've done remarkably well. I think that's part of it. The other part of it is just residential real estate. Due to the circumstances surrounding this pandemic, it's just been more resilient than other classes of real estate. So if I was in office properties or I was in hotels, or I was in retail strip centers, I would probably be telling a different story as well. So, residential's been very strong. Residents have been paying their rents in part because of various fiscal stimulus programs that have been in place in the past, but in part because you're confined to your home through these stay-at-home orders, and you need a home. So if you need a home, you got to pay for it, and people are doing that.
All right. Well, I want to dig into that more. What you just said too about if you need a home, you're going to pay for it. But here in a little bit throughout this and what's going on with forbearances and people losing their jobs still and all the furloughs that are out there and what might that actually entail into 2021. But first, let's go into with Dave Van Horn. So Dave,
yes,
we started out in earlier this year talking together. You were the only panelist I think we had that was like stoked, like excited about what was going on.
I don't know about that.
Well, I mean, like maybe we should have publicly say that, but I don't know. But
yeah, no,
yeah.
I mean, our number one economic indicator is always unemployment. So if unemployment's high, we tend to do well. So that's I don't know how you sugarcoat that piece of it. You kind of can't. But I think we saw some dramatic differences too. And then certain things were unexpected and some things were better than we thought, right? And going into it, as far as deployment, we've deployed $40 million this year into assets, which is good. But what we're noticing is that our revenue's down, obviously. And it's not that it's lost revenue, it's just pushed into 21. Mm-hmm. So it's almost like if we could combine both years together, it's kind of like, so a lot of our revenue's delayed into 21, and it's due to the moratoriums and things like that. And we are doing some things to increase revenue. We're upticking our note sales rate. Actually, we're working on a very big note sale right now. So we're doing that to compensate for some of that. And then we also did some other tactics as well. Like we implemented a pretty robust deed in lieu program, basically to circumvent the court system. But we did get out of a lot more property than we thought initially. So not every state shut down in the beginning. It was kind of interesting. Only about half the states. And then, eventually it got to where it was pretty slow. And then it's pretty slow right now. Although we have, I bet you I have 30 foreclosures coming up. But a lot of them are due to certain localities or they're vacant, or deceased borrower, all kinds of stuff like that. Some things are still moving along, but the bulk of it isn't. But it should be picking back. The question will be, when will it pick back up? And it looks like that's dependent on a couple of things. Not that I don't want to be political, but some of this will be based on stimulus. And if there's, how much stimulus we get in addition to what we've already gotten, and how long the moratoriums will last. Will they last to the end of this year? Will they last to April? Will they last to June? And that'll just prolong our revenue. But the good news for us is we typically already own the assets, and they don't necessarily lose a ton of value in every type of asset. Especially real estate values were up. I know Brian mentioned that. On a personal note, some things got flipped around. Like I was originally trying to go to, me and my wife were looking to live half the year down south, and we were looking in the Austin area, and that kind of got flip-flopped. And I'm actually renovating a primary up here, and then we're actually going to Austin this spring. So everything got miscombobulated. We had to cancel our plans, our trips, our places that we had rented, all that good stuff that like everybody else had. The other thing was I had some personal properties like SFRs, single family, and I had been paying them off and transferring them into a family trust. And the market all of a sudden got really brisk after the shutdown. It seemed like even at PPR, we were seeing 13 and 14 offers on properties. And this is in various locations. So it was really bizarre. And what ended up happening was I got 2 offers on my portfolio, and I'm actually taking one, and I'm supposed to be selling the 14 properties by the end of the year to a gentleman. And he's getting a good deal. He's a buy and hold guy. He's younger. He's in accumulation mode. He's getting good, cheap money right now. Mm-hmm. And for me, I'm more in preservation mode, and it's a good time for me to sell these assets, reposition that equity into something else. Good time to take profit off the table, just like Brian was alluding to with his multifamily stuff. So it did alter some plans, but I think guys like Brian will just adjust, right? We just adjust to what's happening as we see it.
I guess that's a good point as far as I actually liked what you said there. Like you're in preservation mode versus some people are in accumulation. And like, that's something that I don't think people talk about enough, like, especially with where your investment strategy is going to be, like what side of wealth building are you in, right? Especially right now, like it's not saying that you're looking like you want to go to retirement here soon, but you look like you actually probably are going to want to build some more currently with what's happening, potentially. And, but whereas like, let's say that you're somebody like this gentleman that's buying your properties currently, he's building, right? And you mentioned as well, one of the benefits of what has happened is rates have dropped dramatically. So he's getting cheap money. And that's something that, might be a good thing, but whether or not it's a good thing long-term, who knows? We'll discuss that later. But I guess that's something for people to take into account. Like, where are you right now in your real estate investment journey, right? Do you already have 1,000 properties or do you have none, right? And what should you be doing today is the question. So Jay Scott, so what have you done in real estate this year so far, now that we're November 11th, 2020?
Yeah. So if anybody remembers, I made some really bad predictions last year. Well, not necessarily bad, but I was saying last year that I felt like the economy was going to turn, and well, I mean, in a way, I guess I was right.
Yes.
I didn't predict this, but so last year, basically, I said, okay, I'm going to slow down and I'm going to get into wait and see mode, and 2020 is kind of be one of those years that I kind of sit back and I don't take massive action in real estate. I started focusing on some business interests, and basically COVID hit and I was like, hey, I'm a genius. Look at this. The market's going to crash and the real estate market's going to go down, and I'm going to look like an absolute genius. And here we are, what is it, 8 months later, 9 months later, and clearly the real estate market has held up and things have done well, and not necessarily going to credit the economy for that, but there are things that are going on in the economy that have allowed the real estate market to be propped up very nicely. And so not quickly, but between March and June, I realized that, well, now maybe there is an opportunity that I hadn't recognized earlier, and I have no problem admitting when I'm wrong and I need to kind of change lanes. And so around the June timeframe, I said, okay, and I'm not gonna put all my eggs in any basket, but I'm gonna be opportunistic, and I'm gonna see where there are opportunities. And so between June and now, we've bought I think 9 or 10 rental properties in Georgia, and between Georgia and Florida. We've probably done a half dozen flips. Done a note or two, and just got done doing my first multifamily deal, 150 unit, also in Houston, like Brian, which a market that we absolutely love. So we're kind of doing a whole lot of stuff, and like I said, we're being opportunistic, and we're not putting all our eggs in any basket. But we're keeping an eye on the market, and hopefully by next year we'll be kind of focused again, although it's not clear where.
So that's a different journey for sure. I mean, who knows though, Jay? And let's talk about 2021 here in a minute. But like, maybe you're not wrong. Maybe you're just timing's off as far as.
Well, I mean, it's safe to say that the market's always going to balloon and it's always going to crash. I mean, I can safely say that the market is going to crash and the market's going to skyrocket. I can't safely say when. So yeah, I'm not a genius for predicting cycles. And predicting when things are going to happen. I'm the first to say, like, you can look at all the signs, but it can be really difficult to know. And what we've seen is, even though the economy is kind of in shambles right now, and may not feel that way to some people, but if you look at the underlying data, the economy really is in shambles. But just because the economy is in shambles doesn't necessarily mean the real estate market's going to be, or other markets are necessarily going to be. I mean, the stock market's at a near all-time high. So these things, while correlated, aren't necessarily directly correlated, and they're not necessarily time correlated. So sometimes there's a lag or a lead in certain of these things. So even if you can predict the economy perfectly, it doesn't mean you can necessarily predict real estate or the stock market or other things. Which is why I like to tell people you need to be prepared and flexible, and you need to be able to pivot when the market's telling you to pivot.
Good point on all that. And so, I mean, like, really, that's part of what investing is. It's like, if everybody knew, like, oh yeah, this is going to happen, like right here, this is the next 12-month projections, 5 years projections, and they're guaranteed. Like, that's not that. Yep. That doesn't really work that way.
So, I start every conversation with, "Don't trust anything I say," and this is the reason. because we were doing these. The four of us were here, I think 7 or 8 months ago, and I was saying, wow, like with COVID, I mean, I was positive that by today, the real estate market would be in the toilet. I mean, who could have predicted that we could have had what we had with the economy over the last 8 months, and real estate would be in some markets, not all markets, but in some markets, at an all-time high. So yeah, don't listen to what any of us say, but listen to our reasoning, listen to our underlying fundamental beliefs and why we believe that, and then use your own common sense and follow your own market and come to your own conclusions.
Just know the experts are always right, right?
Yeah.
So on my point, like what we did, I can tell you right now, April, I was just like, fuck, I'm sorry, screw everything. Like I didn't even know what the hell to buy, what to do. Like I was just sitting there going like, I don't need to do anything, so I just won't do anything. And we were in a good spot financially. And I went into preservation mode a little bit to go like, okay, are we in a good spot? Let's just make sure we're in a good spot. And we double checked all that. And then, but lately we still bought properties. We haven't bought like we normally buy, but that part of that was, we were shifting on a lifestyle choice for our businesses already. And so some of that didn't really change anything. We've made a lot of revenue this year in real estate, and more so than we thought we would. But that's just because houses were selling more than we thought they would sell. And so houses going over market, especially in our market. We buy a lot in the Tacoma market and in Washington as well as Seattle. And even though Seattle has had its fame on the news, if you can believe it or not, the real estate market is still pretty strong. Now that might shift and change as the core area of Seattle is changing with too many apartments being built and too many people also wanting to leave. But one of the things that Washington has is we have no state income tax. So it's kind of hard to leave the state. And if you make a high level of income and go to another state, unless they have the income tax situation. So that said though, like, the core area of Seattle, I kind of stayed away from a bit, right? Because of Amazon not being there, and Amazon's thinking about like not letting people go back to work for a while. Boeing with the airplanes and all that great stuff, because that's a great industry to invest in right now, right? Which by the way, I did buy a bunch of airline stock back in March and April, just hoping like that something would happen. But we'll see if that's a long-term play now. Maybe it was a mistake, but I don't know. But real estate's been well with us, but like I've still been cautious, like to be honest with you guys. And that's why I wanted to talk to you guys. But I've been sitting on the sidelines going, what do I do with the capital we have? Do I prepare for 2021? Do I raise more capital for 2021? What's going on with forbearances? What's going on with the eviction moratorium? What's going on with the CARES Act, the stimulus? Dave, you brought up stimulus and what might be happening with that. And right now, I guess this is what we're going to talk about the rest of this panel is be experts, right? And project potentially what we believe is going to happen. But that's part of investing is we're going to make a gamble, quote, quote, an educated guess on where to put our money and hope that we get a better return, right? But through educated financials, guesses, strategies, all that great stuff, right? Is that pretty much what investing is?
Yeah.
So Brian, with what you got going on in multifamily, are you going to be doubling down on multifamily going into 2021? Or are you going to be doing something else?
No, we're sticking to multifamily. You know, I'm always evaluating, you know, what's working and where. You know, that's always part of a long-term real estate strategy is always to look for the right strategy on the right location where it's working under whatever circumstances are being dealt. And I still feel that residential real estate's, you know, second only to industrial will be the shining star of the real estate class.
Really?
Yeah, industrial is probably going to be the top real estate class. It's just very difficult to, it's just a different market. It's really difficult to execute that market on scale, you know, especially for, you know, smaller operators, REITs and that kind of stuff, you know, where you got hundreds and hundreds of millions and even hundreds of billions of dollars to deploy. You know, they can successfully execute industrial strategy at scale better than we can. Our core competency is in residential. So I'm going to stick to what is working for us and stick to residential. So having said that, you know, we are still doing some flips locally here, you know, in California. We have teams for that, and we'll still be doing some of that primarily because I think that there will be some increased foreclosure volume going into 2021, which may allow some opportunity there. But our core business and the bulk of our business is going to remain on the multifamily side. We raised a fund, a $50 fund. We've got about 40 million raised and about 10 million to go. And we've already deployed, 13 million on our first acquisition. Our second one that's in contract is another 15. So, we're going to have a little bit more money to spend in that fund. And if we do get some joint venture equity from some institutional investors, which we're seeking to do, we could potentially buy, about $400 or $500 million in assets with that $50 million fund. So, that's really what we're looking to do and probably do that going into 2021.
So you're saying that also, you mentioned this briefly and I'm sure there's people actually thinking about this right now, but you're like, the industrial market is going to be a good market outside of residential. What specifically do you mean about industrial?
Well, right now you look at the shift of shopping to e-commerce, right? So, the distribution centers, warehouses, you don't have to keep your products for sale in a retail store now. You can store them in some off the beaten path industrial warehouse, and you're going to sell more products out of there than the guy who's got a really expensive retail at the corner of Main and Main. Oh. So, the retail properties are, in my opinion, going to suffer, significantly, and the industrial is going to do just fine. You've got, all these states are legalizing marijuana. So you've got these indoor weed grow operations, and they're taking up, in California here, they're taking up a ton of warehouse space for their grow operations and sorting and all that kind of stuff. So now you're trying to get a distribution center in for other products that people use, and all the warehouse space is taken up by all the weed guys. So, it's created an intense demand for warehouse space, and this stuff can be located anywhere. I mean, within, reasonable transportation distance. It doesn't have to be located on a visible corner or a high traffic street. It just has to have, the access in and out for trucks and that sort of stuff. So there's I think a lot of opportunity there, but it's not a casual player's game.
No. Yeah,
there's a whole lot of real estate zoned industrial, and industrial is like 10 different niches. And so unless you have the cash to diversify and make some bets, or you have some inside information, or your market and industry tremendously well, it's tough to it's not like residential where like you're going to make your 6% or your 8% or your 10% year over year. It's like you're going to see a lot of variance and there's some risk.
Yeah, I remember about a year and a half ago, I had an opportunity to buy a pretty good sized piece of industrial property because it was through this estate sale that I was buying other properties through. And I'm like, cool. And I looked at it, I'm like, I have no idea what any of this is or what this means. It's like, it was such a foreign thing. I'm like, and we just said, okay, we'll pass. And it was just a Pandora's box to me when it came to that. But I was very curious. And I also like so Brian, you're saying that, so earlier this year, we were talking about multifamily. We were on, I remember going multifamily is going to get hit. And with what's happening, because we thought nobody's going to pay the rent. And so, you're basically saying that nah, that's not going to be the case. I'm good to go with multifamily. Are you going to be doing a specific type of multifamily, or are you just going to keep buying value adds, or what are you looking for?
Yeah, we're doing value add, but we have upclassed. We were, originally we were buying, class B and C apartments. Now we're in A and B. We're not really looking in the class C space. We're not looking at anything built before 1980. The one property we've closed on was built in, I think, 86. The one we're in escrow on is built in 2001. So we're looking at the newer stuff, a little bit higher rent profile. We're paying very close attention to school district ratings, median incomes, that sort of stuff to help us get a little bit of resiliency. We are looking very carefully at in-place delinquency. Now one of the first things I want used to be, give me a rent roll and a trailing 12 financial statement. We can pretty much decide how much to pay for that property. Well, now in addition to those two things, we need a accounts receivable aging report. I want to see how many tenants aren't paying and how long has that been going on. And one of the property that we're buying, they had one guy that was 1 month behind and he had a promise to pay, and everybody else was current. And, that says a lot about the resident profile at that property and, and how well they're paying. And we found, at our newer properties, people are paying. Delinquency hasn't been a huge issue at a lot of those properties. We have a couple that have been a challenge, and it's really kind of hit and miss. And that's been the surprising part is, we'll have one property where everybody's paying. We got another one where you have 15% of them aren't paying, and there's really kind of no rhyme or reason to it.
They all talk to each other.
Yeah, probably.
We have a few friends that are in the C, like they buy a lot of C-class apartments, and it seems like those are the friends that are having the most struggle, especially if they're buying a value add, because then they can't remove the people not paying. And they are stuck. And then nobody knew when they fix up the other units and make them brand new and shiny, nobody wants to move into them. And because of some of the tenants that are still left in these buildings.
Well, it's funny you say that, Tarl. Our C-class properties are the worst performers that we have right now. And it's funny, I've been saying this for years, and people on podcasts have always kind of thought I was crazy, because the general belief out there was, buy C-class properties because, those are the lowest tier on the ladder, and those people always need a place to live. So you'll always do great in C-class property. And, and all these years I've been saying C-class are the worst because when the economy goes south, they get hit the hardest. Your A's and B's do better. And people would say, that's reverse thinking. I even put it in my book, I think, a paragraph or two about this. And people thought I was crazy, but it's exactly what's playing out right now.
Mm. So let's switch over to Jason. Check.
He's going to go look it up.
Yeah.
You guys are listening to us only.
Page is that on, Jay?
Yeah. So we should have, I think Joe Rogan has his fact checker. I can't remember his name on his podcast. So anytime somebody says something like what you just said, Brian, they'd be like, let's check that fact right now live. And so Jay,
make sure he's not lying about what's in his book.
That's right. So what would he know? He didn't. He did right. Dave Van Horn. So you have, as far as you had mentioned that your number one indicator for how well your business does, and for people that are still not understanding what Dave does, he buys notes, right? That's his main business. Specifically, he loves things called distressed assets or distressed debt. And those are people that are projected to not pay or are not paying and need to be caught up in some way, and many other aspects. So and he bids on these big portfolios of notes and buys them with lots of money that he raises capital for, and then turns those notes into either performing assets or recaptures the property itself in some capacity, and then turns it into a profit situation. So you had said that your number one indicator is unemployment, and that's why you were relatively excited earlier this year for your business, right? Maybe not for the general state of the economy. And so going into 2021, how do you see your business faring based on what you understand with what's going on today?
It's actually pretty predictable. Once things open back up, you're just going to see a mad rush to the courthouse to get evictions through, foreclosures through, which is kind of, so you're going to see some delays. But with the unemployment, it depends how long they extend benefits, but at some point the music stops, and then you have to deal with any fallout that we have. And there will be something. Not everybody's going to go back to work like it was pre-COVID, or they're not going to go back to work in the same way. So there's definitely going to be some casualties, unfortunately. And it'll probably be the second half or end of 21 before that starts to happen. So we were actually pretty tiered up to, raise a lot of money, and we were going like gangbusters, and then COVID hit, and then all of a sudden, we actually stopped raising money because it would be like raising money at a funeral or something. So you kind of, we stopped, and then, things actually started picking back up again. And there was actually a little blip there where there were actually some really good deals came into play, and it was right after the shutdown. So we had some securitizations collapse. We had some unique opportunities. So that was actually pretty positive. And then now we're back into the same mode. We're actually applying for an MRA, which is a big line of credit, just to be prepared for when things start to go in our favor, we think. Now, the other piece is a lot of notes are in direct correlation to real estate values. And pre-COVID, real estate values were pretty high, pretty much around the country. Generally speaking, or they were back to where things were before the last crash. That everything had kind of risen. High tide raises all ships, kind of thing. And there was very thin margins in our space. It was very predictable, but it was just steady. And then, not saying we wanted this type of disruption, but sometimes when there's a disruption in the marketplace, stock market, you want to see movement. It almost doesn't matter what the movement is. You just want to see movement. And that's kind of what some of this was. But the real thing that I think will be interesting to see is not so much just the stimulus or how long unemployment can continue and things like that, but will the Fed eventually jump in to try to hold back some inflation? Like, let's say there was a lot of stimulus and then things were going like gangbusters for a little bit. It's a little bit artificial. And then will the Fed come in and start to raise some rates or some things like that? But I really don't see the single family residential market. It might level off, it might dip a little, but I don't really see it doing any kind of nosedive or anything. I'm kind of in Brian's camp where I think it's a solid investment vehicle. This really wasn't a real estate collapse. It was a medical event, and it'll take a medical solution to get us out of it. And that's kind of happening right now, right?
Yeah, but there's a lot of massive economic situations that have happened due to this, right?
Yeah.
And I mean, despite that, unemployment is one thing. For a lot of people are furloughed, and a lot of those people, are projected to not get their job back. And depending on how the businesses have fared, right? And I guess that's one of the questions. And I would think that
it might be the retail space or the office space that I think is going to really get impacted a lot. I think the residential should be solid, but I guess you could always make the argument if enough businesses and enough office space was impacted, eventually it would impact residential because they just wouldn't be able to pay, or there wouldn't be enough jobs, or whatever that is.
Well, what about,
recession,
it's that trickle down economics though. I got to ask that question where you have like the double tree or I'm on Maui right now and you guys can't see, but Wailea is like right here and it's empty. Right. And like all the resorts here are empty. And in addition to that, we were at a hotel not long ago, Embassy Suites. We ran an event, right, during COVID. They gave us an entire floor, and all of our friends stayed there, and we were the only people in the entire building. And that was just a few weeks ago. And so all these situations, and you have all these big corporate buildings, that massive commercial buildings in downtown areas like San Francisco, New York, Seattle, right, throughout LA, and that are ghost towns. What about all the investor capital that are invested in those buildings, such as, I don't know, CalPERS, the California State Employee Pension Plans, all the different REITs that are out there, the mutual funds, all the things that the institutional capital that are invested behind those type of buildings. What about what happens if that music stops there and those buildings don't get back and they don't get repurposed in some way? What does that do to middle income America? Any questions? Any thoughts on that?
Well, you could say the same thing with the government too, right? But I'm kind of with Brian that it depends where it is. Like my youngest son lives in downtown New York. There's a lot of vacancy there, right? And that's going to take a long time to recover. But then there's rural places that are taking off like crazy because people want to get away. But I think what you're going to start to see is by, whether it's the middle of 21 or towards the end of 21, you're going to start to see some normalcy and people start to travel again. Will they start to go back? But I don't know that we're all going back to work in the same way. I really doubt my employees are going to be in the office 5 days a week anymore. That's I just don't see that happening. I see us as more of a 2-day a week company or something, where people are in the office rotating, that kind of thing. So it's going to be a whole new world order. And I know for a fact, I'll never need another inch of office space more than I have today. Right. So there's no expansion in my mind. Whereas in the past, pre-COVID, I might have had different viewpoint of that,
What about I'm really excited for the fact I bought 2 commercial buildings that are retail and office space zoning right before COVID hit. So yay, that's exciting. But no joke there. But I could develop multifamily on them, so they do have that as well. But that's one. But you mentioned inflation, and this is open to you, Jay and Brian, to talk about and what might happen with inflation and possibly curbing inflation later with the Feds. From my understanding, we live on a fiat system, so where there's really no. And not for everybody, there's no backing on our dollar. It's just
you understand correctly.
Yes, it's an IOU, right? That's backed on how good everything is. But in that scenario though, like inflation kind of needs to happen in order from my understanding at least, in order for a fiat system to continue to grow. And the Feds have said they want inflation right now. And in order to, and I'm totally assuming that the reason they want inflation is so the dollar doesn't collapse, but that's my assumption. And so one of us are a belief that I think inflation is going to continue to go up, right? And I don't see a reason for that to stop. And I also don't see a reason for the Feds to raise interest rates right now, especially, and with what's going on. But what would that impact in 2021 with all these? If the CARES Act stops, if all of a sudden forbearances are allowed to get foreclosed on, but rates are still low, right? And there's a big demand for property. Well, how will that affect single families, Jay? How will that affect multifamily, Brian? How will that affect the note space, Dave, if at all?
So let me start with like I said before, don't trust anything I say because I'm wrong plenty. But I'd be willing to bet a whole lot of what I own that interest rates are going to stay low in 2021 and 2022 and probably 2023, 4, and 5. Like you said, Tarl, in a fiat system, you need inflation. Inflation helps businesses, and businesses are more important to the economy from the Fed standpoint than individuals. So individuals like not having inflation, but businesses like inflation because they make more money, and that's good for the economy. And whenever we're talking about inflation, it's kind of like there's all these forces that kind of work against each other. And certainly we talk about the big one that Dave mentioned, stimulus and printing lots of money. And printing lots of money is kind of on this side pushing inflation up. But a lot of times we don't think about all the things on this side that are kind of pushing back on inflation. Number one is it's really hard to have inflation if you don't have a strong economy. As long as the economy is weak, people aren't spending money, and you're not going to see inflation. You get inflation because people spend lots of money and businesses need to raise prices to bring in more employees and equipment and inventory and warehouse space and all that. When people aren't spending a lot of money and the economy isn't strong, we don't get inflation. Number two, there's this natural tendency away from inflation. It's kind of like gravity. Gravity pushes things down. In economics, there's a natural tendency to push against inflation. So if the government doesn't do anything, we're going to tend towards deflation. So we're always fighting against this natural tendency to push back and go the other direction. That said, and then there's number three, which is our Fed has said in the last month or so that they want more inflation. Like we've been targeting a certain amount of inflation for the last few years, and the Fed is now saying we need more, we need more, we need more. So there are a whole lot of things on this side kind of pushing in the opposite direction, saying, hey, we're not going to have to worry about inflation for the next couple of years. Certainly, then there are other things that lead towards inflation. All the stimulus pushes this way, and automation, the fact that businesses can do things more efficiently, that pushes towards inflation. So we always have these things that are pushing against each other. And if you kind of net them all out, it looks to a lot of people and people that are smarter than I am. But if I had to throw in my 1.5 cents, I would agree. I think we're likely to see not a ton of inflation for the next couple of years. And like Dave alluded to, if you're not seeing inflation, you don't have to raise interest rates. You raise interest rates to curb inflation, and you keep them down to encourage inflation. So I think for at least the next 2 or 3 years, 4 years, 5 years, maybe we're going to see low interest rates. So let me start with that. In terms of how that's going to affect the real estate market, obviously it's going to help the real estate market. I'm not sure we're going to turbocharge the real estate market more than we already have. I don't at this point see us lowering interest rates below zero. But the government interest rate, the federal funds rate, is at 0%. So I think that's going to help real estate moving forward. But it's not going, we can't lower them any further. So I don't think that's going to be something that's going to turbocharge real estate in 2021. But the low rates are certainly going to help. The bigger question is going to be around supply and demand, as far as I'm concerned. Right now, we have a lot of demand. People want real estate. People are saving a lot of money. A lot of people are doing well in this economy. It's a very dichotomous sort of thing. A lot of people are getting hurt, but there are a lot of people that are doing very well. And so there's a lot of demand for real estate, but there's not a lot of supply. So people aren't selling as much. I mean, in my town, sales, the number of listed houses are down 25% year over year. My take is, and I don't know for certain, but my guess is it's just because there are a lot of people with COVID that don't want to sell right now because they don't want people trouncing through their house. But at some point, COVID is going to go away, and there are going to be a whole lot of people. All this pent up supply is going to release, and there are going to be a whole lot of people who said, "Hey, I was thinking about selling last year and the year before, and I couldn't do it. Now's the time to sell." And I think with the eviction moratorium, we're going to have a whole bunch of people, or the forbearances and eviction moratorium, we're going to have a whole bunch of people that are in a financial position. So as supply is going up, demand is likely to drop. And basically what I think we're going to see is a softening in the real estate market over the next year or two. When that's going to start, whether it's 3 months or 6 months or 12 months, I peg it at whenever stimulus kind of runs out, whenever the government says, hey, we kind of have to start weaning us off the stimulus. That's when we're going to see this start happening. And when moratorium ends and when the forbearances end, and when COVID goes away, those are all going to kind of be the triggers for kind of the softening in the real estate market. So I think the next 3 to 12 months, and I know that's a big range, but that's my take.
Look, I actually agree with you, and but I agree.
Wow, amazing!
Actually, I know this is a big deal. Actually, we almost always agree. But I think but I think for different reasons though. And for on the one side, I see, okay, well, if stimulus doesn't stop, that means a hell of a lot more printing of money, which then, from my understanding again, that helps spike inflation, right? And continues to devalue our dollar, which then creates a different economic situation altogether, potentially. But let's say stimulus does stop. And why is that important for real estate investors to understand the stimulus side? Is that you have this thing called the CARES Act, you have the forbearances, you have the unemployment, enhanced unemployment, you have the foreclosure moratoriums, the eviction moratoriums, all these things that are going on. And Dave, I want to kind of pose this to you. I've talked to a few larger banks and a few large servicers out there. I've been a part of some events with some of those people recently, and they're saying to that entire industry that they have a very, 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 very large, backlog of potential defaults, of defaults, right, due to forbearances, and people that are either going to get foreclosed on in some sort of situation if they can't get caught up once the forbearance is done. And correct me if I'm wrong too, but from my understanding, if somebody's in forbearance and they still have a job and they're still able to make their payment later, they can do a very quick loan modification once the forbearance ends to basically take all those payments and put it on the back end, right? But from what I also understand, talking to these servicers and banks, is that if they don't have a job anymore, they have no ability to pay, and the forbearance ends, then they can't do a loan mod in that case.
Yeah, you have to qualify for the loan mod.
You have to qualify for the loan mod.
Yeah.
And I think that's a huge misunderstanding that's out there with how this actually works, is that it's not just they said I could put it on the back end of my loan. A note is a contract, right, Dave? A note is an actual contract, and it needs to be modified
at some point.
Yeah, it needs to be modified, but in order to modify it, you got to requalify for it. And if you have no income in the household, then you don't qualify. And so, but maybe that goes back to what you just said, Jay, about that's going to increase supply, because if rates are low, demand's high, and unlike the last crash, demand dropped and supply went up dramatically. If rates are still low, you're still going to have a high demand, but then supply will increase because instead of people getting foreclosed, they have equity and they're able to just put the house on the market instead. Or they'll put their head in the sand and the bank will take their house. But Dave, what do you think about all of that?
I think Jay was half right.
Okay.
I tend to think it's out a little farther. I think three months is aggressive. I think it's going to be more like 6 to 18, maybe even 24, where you really start to see some impact. And you're going to see a lot more distressed assets start to hit the market. And it's just going to take a while to get through the system. And you're going to see some government pushback trying to slow it down and things like that. But eventually, some of this stuff, to your point, is not going to go away. And it's about their ability to pay. They either have it or they don't. And if they don't go back to work, they don't have it. And it's really do we really believe everybody's going back to work when the unemployment runs out or the stimulus runs out? And we kind of know that answer already. So it's going to be a new time period, and there's going to be more supply. So I'm kind of with Jay there. I think I don't see a huge drop in pricing or anything, but I could see it leveling off or dropping a little bit, that kind of thing.
Yeah, I agree.
I do believe rates will be pretty low for a while. So.
Yeah, and I wasn't saying that I think we're going to see a whole lot of distressed inventory hitting the market in the next 3 to 12 months. I just see that whole supply and demand curve kind of normalizing and us starting to see a softening. And I agree with Dave that it could be a year or two. Like this may not be like that 6-month recession that we typically see. This could be a year or two while things kind of work their way through the system and the government's kind of doing their best to kind of keep things propped up without spending too much money and just kind of smoothing the curve. But it's not getting us over the hump.
Yeah, see, and we're talking about, just so we're talking about I'm understanding that we're talking about residential here, right? And the specifically residential. So Brian, like talking to you, because you're more in that space and you see commercial as well, but like there could still be a crash, but maybe it's not be in residential. And so, we talked about commercial earlier, but what do you see kind of happening with commercial space these days and into 2021? Do we see that normalizing, or do we see that potentially going down the tank?
Well, I think commercial is going to have some lingering problems, primarily just because of the activity. It's just people are staying home. People are not going out to eat. Restaurants are closed. Stores are either closed or at reduced capacity, and all those kinds of things are going to have a lasting impact on the commercial real estate side. There was a thing I read here recently. I just pulled it up. I think it's really interesting and kind of telling of, one of the things that's holding us back. This was a Washington Post and University of Maryland poll, and we all know that pollsters don't get everything right? It says that 56% of consumers across the nation intend to shop at the supermarket. Only 56%. So there's a lot of people that are afraid to go to the grocery store. It says this poll
as a University of Maryland grad, I can vouch for the fact that they know what they're talking about.
Okay, well then that just settles it. This is you can take this to the bank. So here's another one. Only 33% say they are comfortable entering a retail store, and a mere 22% say they're willing to dine in a sit-in restaurant.
Was this poll done in California?
You would think this says across the nation. So maybe they polled Californians across the nation.
Yeah, which they've all migrated.
They've all migrated, so you can find them everywhere. Maybe that's exactly what happened. But the point of all this, and the reason I think about this and how it relates to real estate, is that if people don't have the confidence to go out, then that's going to create all sorts of things. And so I look at markets like Las Vegas. Las Vegas was really firing on all cylinders last year. I mean, the real estate market was doing well, rental market was doing well. Now you look at, the COVID situation, they completely shut the town down. I mean, I used to make a joke about California and our rolling blackouts. And I would say, I'm going to move to Vegas because ain't no one turning off the lights on Las Vegas. And then what happens? Las Vegas shuts the lights off. So that literally, to me is something that I never thought I would see happen. And it did. And so now, people aren't traveling there. They aren't going to the big conferences and, all those big trade shows and stuff that happens there. And when you think about the people that would cater those or take tickets at the front door or park cars, and all the different things and cook the food, all that stuff that happens in association with those events is not happening. And it's going to take a while before that stuff starts to happen again. Live concerts, there's been no live concerts. And so you think about all the security staff and all the people that you see at those live concerts. Well, what are they doing? So the amount of time that it's going to take for all these people to get back to work is so long that it's just going to create this hanging malaise over the real estate market that's going to go for a while. And so, I don't have much to add about Jay's economic analysis, because there's few people in this world that I think are smarter about that than he is. But I think he's nailed it, and it's gonna take a lot of time. There's gonna be low interest rates for a while. There's not gonna be much inflation. What you see is what you get, and it's gonna take a while to climb out of this. People talk about V-shaped recoveries, U-shaped recoveries. I said it at the beginning of this pandemic, and I'll say it again. I think that this recovery is going to look like the Nike logo. You have a sharp drop followed by a very slow but steady climb back to where you started.
Mm. So I think that where there's a lot of people on the sidelines right now saying, I don't want to invest until the market crashes, right? And there's a lot of people, I've heard this for years, but it's now the time to invest, because it seems like the market's at its peak right now. So, I'll just wait till it crashes and I'll be ready this time. Well, one, if that happened, they probably wouldn't invest because they'd be freaking out and not investing. But because the average person that says that would not have invested in 2009 because they didn't. And now they're like, I'll wait for the next one. None of us really predict a crash in the residential space. I have some thoughts on commercial a little bit more so, but I think that's going to affect people a little bit more than we kind of think. I run an events company, right? It's like full disclosure. Our revenue is a fraction of what it was last year. And we deal with the hotels regularly. We deal with production places and AV companies and all this kind of stuff. And just seeing the destruction in that entire industry is just incredible. In a lot of levels, and how that affects the hotel industry is insanity, because most people think the hotel industry makes most of their money on the rooms. No, they make their money on events, because that's what fills the rooms. And so that's their entire bread and butter for the most part is events and conferences
and landscaping
and landscaping. And so
Four Seasons.
Yes. Four Seasons. Absolutely. So it's, and how does that affect the rest of the economy is more than people think, because these are publicly traded companies, right? These are companies that people invest into. Your retirement's invested in that. If you're invested in paper assets, you don't even realize it. So it's just things like that. I think there's going to be a bigger hit there than we project. But on single family, I think we're all good on that, right? Multifamily.
I think so. And people that are waiting for a crash are going to be in perpetual wait mode. I don't see a crash anytime soon, but I know there's some questions in the Q&A box that people have been asking about. How do we get good deals on real estate, or how do we find that one-off, single family rental purchase, or, and find a good deal on that? And, it's really, really difficult right now. And it has been difficult for probably the last 5 years to get what a quote unquote good deal on a single family home. You're in competition with end user buyers, and there's a lot of people looking for homes to live in and not make money off of. And that's who you're competing against. It's very, very difficult. But I think that's going to change to an extent. There's a massive rush for people to buy a better house or a bigger house or have a home office or whatever it is that they're doing right now, a house with a pool. I know that's a big thing out in New York. People leave in New York City to go to Connecticut and get a house with a pool. This is all kind of a thing. Well, eventually they, get all that worked out, right? And now foreclosures start to increase because, moratoriums are over. And as you said, Tarl, there's borrowers that can't qualify for the loan modification. So if foreclosure starts in California, the fastest you can process a foreclosure is 111 days. And that's if you do every timeline to the minute. Yep. So, you're looking at 4 to 5 months after people decide that they can even foreclose before you'll start to see foreclosures. So, you're a year out from that. When that starts to happen, that will naturally increase some of the inventory. And it'll be the type of inventory that might make a good investment because it might, have some opportunity to fix it up and that sort of thing. So I think, if you're looking to make that first investment, or if you're looking for a quote unquote good deal, just be patient. I mean, that's the best advice I can offer, because this is going to take a while, and it's going to be around, and there's going to be opportunities. Now, a crash, I don't see it, but opportunity, I think so.
Well, even switch. I love that you brought up the California 111 days. You got 90 days for default and 21 day for notice of trustee sale. I still remember that. I'm from California. But you look at like states like Oregon that are judicial states, and you have like what New Jersey I think is in judicial. I could be wrong, but you have Florida. I believe is both. Dave, you'll know this better, but you talked about earlier, Dave, like the court system, because if you have a judicial situation, you have to go through the courts from what
it can be much longer. I mean, we have states that are 3 years.
3 years.
Oh yeah, and sometimes we'll go to receivership, or it depends if they're occupied or vacant or deceased. You can speed things up, but some states are really long. But they trade at different values too. So they trade. It's kind of built into the market. The foreclosure timeline and matrix is built into the pricing of the assets. So they do take that into consideration. But
what that does, though, but the reason why we brought that up was like what that does for like when the market's going to crash, right? Is that I truly believe, and it sounds like you guys do too, and Dave, please add to this, is that when you have these timelines, right? When you have this 111 days, you have this 3 years in some judicial states. Well, we can't afford this. We can't get the loan mod, right? But we have equity. Why don't we sell, right? In some capacity, right? Because equity is a different thing today than it was in 2008, and that might be people putting houses on the market, the MLS, right? Or it might be that they sell off market in some way. How do you foresee all of that kind of playing out?
We kind of don't worry about it. We buy assets in all the states, and an asset manager will typically have 300 or 400 files, and they'll work the short states, the mid-time states, the long-term states, and they're working them all, So it's like they're kind of used to it, and they're priced differently. And then, you typically, you factor all that in. But I'm kind of with Brian that if you're trying to time the market to get a deal, you might have a long time waiting to find the perfect time. And one of the things that I'm looking at, we really have a cheap cost of capital right now. If you want to get into a deal that it doesn't necessarily have to be stellar, it could just be a deal. The cost of capital is so cheap right now that kind of time heals some of that stuff. I look at, I'm actually selling the first property I bought in 1989 right now, and I paid retail. And guess what? It really doesn't freaking matter because the thing's gone up so much. I've refied it like 5 times. Like, just get over it, right? Like, it has really nothing to do with this. And even the high rates, I'm sure Brian has seen high rates. I lived in an owner-occupied house with 11% and 6 points was my mortgage. And I made a lot of money on that house. So, I mean, people get all stuck on some of this nonsense. And interest rates were 14 when I started selling real estate. So right now it's really cheap money. Like, it's free money basically. So
I agree. I'm sorry. I mean to interrupt.
No, you're right.
But both these guys are right. I mean, I have a longtime partner, like over 10 years, who's on this webinar right now listening to this. So I have to give him a little shout out because back in 2010, he's been buying rentals forever. And he's got a nice little collection. And back in 2010, he was like, let's start buying rentals together. I'm like, what are you talking about? It's 2010. I can flip houses. I can do 40, 50 houses a year. Why would I hold on to any of them when I can make all this money? In 2011, he was telling me the same thing. In 2012, by 2013, I was telling him prices are too high. You can't buy any good rentals. So I was saying no in 2013. By 2015, I was laughing at him for buying rentals because, you can't find any good deals. And 16 and 17 and 18, then last year, he's trying to get me to buy rentals. I'm telling him the market's going to crash. What are you talking about? And finally, in June of this year, I said to him, let's start buying rentals. We bought 12 rentals in the last 3 months.
That day he goes like, no, it's too late. It's too high.
It probably is. It probably is. But here's the thing. 10 years, I could have bought, I can't say how many rentals he's bought because I don't want to call him out. But the opportunity that I've missed because I didn't just start buying rentals 10 years ago. And I knew it finally hit me that in 5 years, it doesn't matter if the market goes up or down from here. In 5 or 10 years, I'm going to regret not buying a whole lot more buy and hold. And so anybody that's out there, don't learn from my mistakes. Learn from my 10 years of missing out on appreciation and great cash flow and tax benefits and loan pay down. Don't make that mistake for the next 10 years. In 10 years, I want you to look back and say, I listened to Jay and I didn't make that mistake. So don't go buy bad deals, but don't sit around and wait forever for the next perfect time to buy.
So there you have it, folks. Jay's buying rentals now. It's time to sell.
I told you I'm selling 14, right? Perfect. I should have met Jay a couple
I've always been pretty good at making decent decisions. Not the best, not the worst. I'm kind of the steady as she goes kind of guy.
I got a couple of properties for you. We should talk later. No. but I kind of want to make a almost like a public service announcement to real estate investors out there. Like, here's unfortunate with Bigger Pockets. I love Bigger Pockets to death. Like, you listen to these podcasts, the thing that's not being talked about publicly as much, because it's not everybody's in this world. And I know all four of us understand this. There's billions, and I mean billions of dollars that have been raised by large institutional investor groups, hedge funds that are waiting to buy up as much single family homes as possible. They bought up hundreds and hundreds of thousands and millions of single family homes back between 2011 and 2016-ish, right? And they still buy, but that was when they bought tons of them. I know one group, Invitation Homes, bought over 86,000 homes during that time period, single family homes, right? So Blackstone, right, is going to own everybody here soon. But you're talking billions, multiple billions, and they're waiting. And they're going to buy your property from you, right? They're going to buy your investment portfolio. They're going to buy your stuff, and they're going to put it in there, and they're going to keep it, and they're going to maintain it. And all of a sudden, you're going to have these large REITs, these large hedge funds owning most of the single families out there, as long as you're waiting, right? And so I'm almost saying like, hey, single family investors out there, like, buy up some of these properties so that some of these large ass companies don't take them all, right? And because they're waiting and they want to, and their biggest issue right now is deploying capital. They have too much money, and they can buy cash, and they're looking for a specific rate of return, and that's what they're looking at it as. And you have more flexibility if you're on the ground to go find these off-market deals, to go talk to these sellers, to go deal with these situations and negotiate better with them than these large companies that want to buy them. And think long-term, right? Save America. Anyways, joking. But that's my belief. I'm a big believer in that, because I know these people, right? And anybody want to add to that or take away from that or throw me on the bus? Or
it's funny you say that, because I wasn't even looking to sell my properties, and the first offer was a fund out of New York.
Exactly.
That was going to take the whole portfolio, and then that started the conversation with the younger real estate guy that I know from BP, and we go out to breakfast and all. And next thing you know, I was like, I'd rather give the assets to him. And then the other piece was he was using the same property management company, so I felt better about that, because I've had some tenants over 20 years.
Mm-hmm.
And I didn't want to sell them off to some hedge fund, and then they start evicting them and raising rents and doing all this crazy. Nothing against all that, but I knew this guy would take better care of the people that I had, that I did know for a long period of time. So I was kind of a little more compassionate to go with the other route than the hedge fund route, in my case.
Dude, you're never going to be successful if you have a heart in this business.
I know.
I'm kidding.
You're right.
That was a joke for anybody that wasn't clear.
It's a real thing out there, guys. Like, so for those of you guys listening right now or watching the show, like, it's a real situation. Like, there's billions waiting to buy, right? And they will buy them right underneath me. And it's going to look good as a house flipper in Florida or some other place that has large probability, like basically could buy these turnkey properties and turn them in and sell them directly to these hedge funds. It's quick cash, it's quick flips, all that kind of stuff. They'll buy them from you. It'll be great. You'll make a lot of money right now. But long term.
As someone who's worked in the private equity and the venture capital world, I can tell you there's only one thing worse than making a bad investment, and that's making no investment. Mm-hmm. Because let me tell you something, your investors, they get upset when they lose money, but they get really upset when their money's sitting and they feel like you're not doing anything with it.
Yep.
And so you got more chance of having your investors come back if you lose their money than if you don't invest their money and it just sits. Crazy.
As you're doing the right thing as much as possible. So anyways, all right, we are going on, what are we at? 75 minutes almost. So let us wrap this up in some capacity. So what question do you want to ask? Jay Scott.
What city would you go to? What regions? What questions would you ask yourself to figure out like where you should be buying? And I don't think we're not going to give like specific cities or streets, but in general, let's talk about what trends each of us is seeing in locations and where we should be thinking about buying and not buying. Brian.
Specifically but you have to specify when you give that answer what niche you're talking about.
Yep.
And
yeah, I think on the multifamily side, which is, of course, where the bulk of my business is, I'm buying in places where people are moving to. That's the primary driver. That's the main thing I'm looking for is where are people moving to? So these are areas like Arizona, Texas, Georgia, Florida, Carolinas. These are the places where people are moving to, and that's where we're buying. So on the single family side, it's a little bit different. It depends on what your goals are. If your goal is to fix up and resell, it really doesn't matter. You can do that anywhere. You can do it right in your own backyard. It doesn't matter. The only thing that matters is how much you can buy it for, what it's going to cost you to fix it up, and how much you can sell it for. Those are the three variables. And it doesn't really matter too much where it is, within reason. And then if you're looking to buy single family rentals, again, that can be done in a lot of areas. And there's some places where it can't be done very effectively. If you live in Palo Alto, California, and the median housing price is, $2 million, but, there's other places in California or other states where you can find something within a reasonable drive. So I think, if you're a one-off investor looking to buy rentals for your own portfolio, stick to markets that stick to markets that are kind of close to you or within reason, or somewhere where you have somebody on the ground to be your eyes and ears or your operations team, to take that and do all the little detail work for you. It doesn't make a lot of sense to be buying one single family house clear on the other side of the country in a place you don't know. So, and I think it can be done just about anywhere.
Dave Van Horn.
Yes, mine's a little bit different. Like, we might not be in the smile of the U.S., right? But we're definitely similar in the sense that we're looking at MSAs, right? We're looking where people are. Where are all the people? We're not big fans of rural. And we do have a buy box where most of our product is. It's probably between 1 and 300,000, definitely under $500,000. So where does that put you? And where are there people? And that's kind of where we're buying. But we marry that with the foreclosure matrix timeline and costs of foreclosure as well. And lately, COVID impact maps, because it's kind of moving around the country. And there are some of the things that we look at because it dictates which courthouses are open, which ones are closed, that kind of thing. So it's literally a county by county thing right now for us. But I actually have some good staff that's all they do all day, actually. Track that stuff.
And I would say for me, I agree with Brian. If you're flipping, do it as close to home as is reasonable, because will make it easier to manage. But if you're doing buy and hold or either single family or multifamily, Brian said something years ago. I remember hearing on a podcast that kind of always stuck with me, that there's really three things that matter, and that's population growth, employment growth, and wage growth. I like to add a fourth one these days, which is employment diversity. Don't buy in places that are dependent on any one or two industries. But I think that still holds true very much today. Employment growth, population growth, wage growth, employment diversity. Figure out where people are moving and the jobs are going and the wages are going up. And these days with COVID, a lot of people have a lot more flexibility. Dave mentioned that a lot of his employees aren't going to be coming into the office anymore. And there are a lot of companies right now where people don't have to go into the office, and the employers are saying you never have to come back into the office if you don't want to. And so that gives people the flexibility to live anywhere they want. So where do people want to live? Ask yourself that question. If you can live anywhere, where do people want to live? And typically the answers are places with good weather, high standard of living, low cost of living, and low taxes. And Brian hit on where those are: Georgia and Florida and Texas and Arizona and other places around down there. So if you're looking to buy multifamily, or if you're looking to scale single family, those are all good places to start.
Awesome. I love talking to you guys. And you guys are always awesome to have on the show. And we will do another one next week with potential guests. We don't know yet. But we will definitely do this. I think this is a topic that I think we'll be talking about again, especially once 2021 comes around. So thank you guys for joining us. Brian Burke, where can people get a hold of you?
Through our website, praxcap.com, or investwithpraxis.com, or Instagram at Investor Brian Burke, or on Bigger Pockets.
And Dave Van Horn?
You can't get a hold of me. No, I'm only kidding. PPRnoteco.com, also on Bigger Pockets. And we have a LinkedIn group, Distressed Mortgages group on LinkedIn. And we answer questions literally daily on those forums.
And Mr. J. Scott?
Well, let me start with check out my favorite books. If you're interested in learning about investing passively in syndications, Mr. Brian Burke's book. If you're learning about investing in notes, Mr. Dave Van Horn's book. You're free to check out my books as well, all available. All the books, theirs and mine, on Amazon or Bigger Pockets. Thank you for that plug, Tarl. And anybody wants to get in touch with me, you can, if you want to invest with me or find out about stuff I'm doing, investwithj.com. You can send me an email at j@jscott.com, and I'm on Facebook and Instagram.
And I am Tarl Yarber. You can follow me on Instagram at Tarl Yarber. And also our company Fixated RE, Fixated Real Estate, is always producing content with the Bigger Pockets YouTube channel. So check that out. And we will see you guys next week on the show. Thank you, Brian, Dave, and Jay.
My
Talk
pleasure.
to you guys later.
Thanks, guys.
See you guys.
Thanks, Tarl.